has negotiated through this kind of volatility or not. He's joining us on the show. Rohit Agarwal, the Executive Vice President and Equity Fund Manager at Kotak Life Insurance. Rohit, hi. Thanks so much for making time and speaking with ET. Now, what's happening to the global, global arena right now? Do you think this is just the starting of a downturn, or this is again something that the Indian markets will take in their stride and the outperformance will really continue?
Hi. Well, as you yourselves rightly said, these are volatile times, and some of these yields you haven't seen in the last 2 decades or so. That does not mean that we don't know how to handle it, in my humble opinion. See, what it means is there is macro issues on the corner at the horizon, obviously, especially on the global side. If you look at the US 30 mortgage rate today, that is higher than the Indian rate of mortgage today, or almost the same. That tells you a story which we need to be cognizant of. The risk to the markets globally and India per se is any kind of a blow off that can happen, because given that yields have moved to closer to 5%, there are certainly losses sitting on the books of somebody or the other. Now, the day that comes out, it can lead to some kind of panic. When I say panic, it's not that the risk assets have not already started to cool off, but a panic could be where they just give up, be it equity, be it some other commodities. So that these are not good signs from a global macro side. When we percolate it down to India, the Indian macro, although, is not that bad. Where if you look at the Indian yields, they are closer to 725, 730. If you look at the Indian inflation, after a spike in inflation due to veggies, we expect it to start cool off. So even though India might outperform in the global terms, India will not be immune to global challenges. India will not be immune to the yield rates. For example, if the US 10-year is today yielding 5%, why should a US investor put his money outside his country at all? You are getting risk-free 5% in that country today. So that is a call that many asset allocators might take, and that might impact some flows here and there. But on a standalone basis, India will still stand out in the world as a better place to be in.
Sure. Rohit, I by no means was aiming at pointing how the Indian fund management community will, face it or their capability by any feat. What I meant to say was that, there's a time when this market has very short memories for sure. You'll agree to this, right? And a small part of the market has actually faced and dealt with. That was the point I was making. But at the same time, you have to give our economy due where it deserves. The size of the economy in those 15 years, our reliability or reliance on overseas flows since then, and overall macros have actually become much more stronger, which could help us. But specifically, how much are we intertwined globally on trade front and also in financial market front, which is actually at risk if yields continue to rise from here on? Where will the impact be felt first?
Well, I think flows is the easier one versus trade, because trade is more long-term in nature. Yeah. So if I have to take it more from a market parlance, FI versus FDI. FI is maybe short-term to medium-term money. FDI is long-term money. So it may impact FI money, which is more short-term, but FDI, I do not see any impact, because FDI is money which a country gets for 10, 20, 30, 50 years. If anything, in fact, if you see across the world, it's US who stands out, right? One of the reasons I am told that the yields have gone where they have, because the job starts was higher than anticipated. That means that the economy is still running hot. That means the economy is still doing well. Yes, it means that the desired inflation levels will not be reached just yet, and hence rates either need to go higher or stay higher for longer for inflation to cool off at the desired level. But we have to bear in mind that when inflation is high due to supply factors or demand factors, today you can safely say it is a lot to do with demand, where the demand side in US is not cooling off. Though it is not a good sign, because inflation needs to cool off. But at the same time, you could have some solace that the economy is still not crumbling even with such higher rates. Given on trade and with India, I think, as I explained, it's the FI money which may get impacted in the short run. In the long run, I do not see any impact medium to long run. And FDI, which is where India is doing very well, from Make in India, from people like Apple coming to India and other companies getting ready to come in India. I think if anything, after this short-term turbulence, our country comes out as one of the best winners across the globe. Because if the US companies have to project or make their plans for a China plus one or some diversification away from other countries which have higher macro risks, then India will again stand out, as you yourself mentioned, that our country has grown, our GDP has grown, our macro is more stable today with the impending bond inclusion, which will happen next year.
Right.
The run on the currency is unlikely. Forex reserves are higher. From macro perspective, India will turn out to be one of the best destinations
Sure.
that people across the world will look for FDI, and that is
Right.
what will matter.
No, I think you've made that point. That of course Indian macros are much stronger and the FDI is there. But let's talk markets, Rohit. In terms of the incremental money that you are getting in your, in your kitty, where's the incremental deployment happening to? Which are the sectors you are overweight on or putting fresh money to work in?
Okay. So we continue to be bullish on the capital goods sector. We believe that during the cycle of capital goods in India, if you see typically in a big capital goods cycle, earnings or of the revenues of companies go 4x, EBITDA goes 8x, 10x, and profitability goes anywhere between 15x types. In our opinion, we are somewhere midway in that capex story. If you see in the last 2-3 years, capex was majorly PSU or government driven. Now we are also seeing some signs of private capex coming in. And we believe in the next 2 to 5 years, with the stability that is likely to come in, if there is more stability on the macro and geopolitics, the private capex will also pick up. And there is going to be a good private cycle in the country. So we like cap goods as a sector. On the other hand, we have reduced our overweights on banking and reduced our underweight on IT and got more neutralish on both, with the assumption that in the next 2 quarters or so, after the US is done hiking its rates, at some point in the future, they will have to start cutting rates. Obviously, rates will likely stay higher for longer. But given the resilience of the US economy and other things, we believe after a quarter or two, it's the IT sector which will start to look well. And hence, we have cut our underweights there and at the same time cut our overweights on the financials as well.
Okay, so reduce the overweight on the banking and financials, reduce the underweight on IT, and like the capex theme. Thanks so much, Rohit, for making time and speaking with ET now.